love it. All right. Well, let's go ahead and get started just to be respectful of everyone's time. My name is Saul Garcia. I'll be the host for tonight. So I'll be muting everyone who's talking out of turn and everything. But no, in all seriousness, thank you guys for being here. We're going to dive into some case studies. We talk about strategies and products and all of these different things that, are theoretical in a sense, but we're going to dive into some actual case studies of clients and show you guys how everything performs. So if you got questions, type them into the chat, or if you need it answered immediately, just unmute yourself. I won't be mad at you and just blurt it out. There's only so many of us here. So without further ado, we got Mr. Justin Corpus, the CEO of Truvier Financial, the man, the myth, the legend. And Justin he's taught me everything I know. So he's like my go-to guy. He knows all the different stuff and he'll talk your ear off if you let him. So we're gonna let him go off here. Justin, if you would.
Awesome. Well, thank you, Soul. Just as much as I like to, break down these case studies, I can go off on tangents. Ask Jerry, ask the rest of the team. I love going off on tangents, as you can tell, but we're going to dive deep into specific case studies, just like what Saul said, is with clients utilizing the IUL, utilizing whole life insurance, and utilizing fixed indexed annuities. And so these are actual clients, actual case studies, actual statements that we've been able to accomplish a lot with. So we're going to go deep into these case studies. So let's get started. So first and foremost, let's educate you on the difference between the types of policies. Okay. So the first one is going to be an IUL, an indexed universal life. So it's basically linked to stock market index. It's flexible premium payments. It does have higher growth potential with downside protection. So your floor is zero, but sometimes depending on your company that you work with can be capped at 12%. And they also do have different loan provisions. Sometimes you can borrow at 5%, but the index performs at 10, you get that positive spread. Or if you want to borrow at 2%, they'll credit you to, so it becomes a wash loan. So there's a lot of different loan provisions with the IUL. So now whole life is not as fancy as the IUL. There's guaranteed growth. It's much more conservative than the IUL. Fixed payments, predictable, steady accumulation, and dividend payments. So it's based off the production of that company, based off the growth of that specific whole life insurance company. So both policies build cash value that can be accessed through loans or withdrawals, creating your personal banking system. The key difference lies in the mechanics. So, like I said, IUL offers market linked potential, while whole life provides guaranteed certainty. So, it just comes down to preference. It comes down to if you like more guarantees, are you more for long term and want a little bit more upside? That's where the IUL comes in. The whole life is going to be more so like a high yield savings account, 4 to 6% rate of return, right? So that's just the actual products that we're working with here. And then now a fixed indexed annuity. So this is going to be more so along the lines of a retirement type of product where you're nearing retirement, you don't want any risk in the market, and you want sustainable income. So index link returns, so insurance product that ties your earnings to the performance of a major market index such as the S&P 500. So it's just like the IUL, upside potential, downside protection. The only thing is obviously it doesn't have the loan provisions as say an IUL does. The original investment safeguarded against market downturns, you never lose money, right? So think of this as the best of both worlds, growth potential and market participation combined with the security of guaranteed principal protection. So another thing that what it doesn't say here is guaranteed lifetime income. So annuities are for income. So for the bare bones of what life insurance is, what's life insurance for? For protection, right? For if you die too soon, but we're using a different type of life insurance. A fixed indexed annuity is for if you live too long, outliving your money. So this is lifetime income. This is your personal pension plan. So The first one, I want to show you guys an actual client statement, blocked out names. So the average return for this individual is about close to 25%. So this past year, he earned about a 5%. Obviously, it's conservative growth, but he received $15,000 in credits. So he initially got a 40,000, excuse me, 40%. I mean, 40,000 bonus is good too, but 40% is much more. And so his initial investment was around 202,000. And so now he's already at 316. We've been working with him for a couple of years now. So this is the most recent statement, as you can see, November 21 of 25. So his next statement is going to be obviously the end of this year.
Sorry, can I cut in? What
Yeah.
was the starting kind of, did he front load the policy? Did he throw in a lump sum or was he?
Oh, so this is, yeah, this is an annuity. So one-time dump in.
Okay.
This is going to be $202,000 as an initial dump in. So he rolled over his old 401k. So this is the IRA chassis. And now, excuse me, and now we've grown it to about $316,000
In 1 year.
in 2 years.
That's
So we've worked with him since the end of 23.
gotcha.
So yeah, around November, I think, yeah, around November 23 is when we started working with him. And so over 2 years, we gained over 114 grand, so which is pretty solid.
Nice.
And this is all protected. There's downside protection, upside potential, and then now he also has lifetime income. And so this is just I did a hypothetical, just so you guys can see. So this is an actual illustration, so you can see numbers. So you see the 202 original deposit, and then he has 309 here. As you can see, he accumulates all the way up to about 593 before he turns on his income. And then 29,000, this is going to adjust with inflation. And then overall, by the time he turns 80, the total income he pulled out is he put in 202, pulled out 1.3 million. So obviously these are backdated returns. But again, we like to be conservative and estimate, like I always say, anywhere between 5 to 7, even more so along the lines of 4 to 6. But this is an actual illustration. This is not his account. This is just, I wanted to show you guys what this can actually do as far as the income options. So this is like, let's say you're within 10 to 15 years of retirement and you want to dump in a lump sum, and then this protects you. You put a stop loss. You are no longer losing any money inside of these accounts, and now you have lifetime income. So one thing to note, if it is from a tax-deferred 401k, these withdrawals will be taxed. However, if this is from a Roth, this is also tax-free income. Okay, so that's just the difference between the two. If it's qualified funds versus non-qualified versus, if it's just straight from the bank, right? So that's an annuity. This is a different type of, this is not an IUL. This is not a whole life policy where you can borrow against it and all of the bells and whistles that it has. This is just, this serves a different purpose. This is for lifetime income.
So sorry, another question.
Yeah.
For I see the withdrawal start at age or at year 11, right? So then that means for this specific annuity, he has to wait up until then to start collecting, or can he start sooner?
So if he has, if he, again, it depends on the product, right? So if it's this specific product,
Hmm.
right, it's probably recommended that he waits around that 10th, 11th year to start pulling income. He can pull out 10% withdrawals every single year if he like to, penalty free. However, that can slowly, basically pull from the principal, right?
Right.
So by the time he turns on income, this wouldn't be 29, it would be maybe like 21, right? So, or 22, Um, but yeah, so he's not like locked in and he can't take any of his money. He can take 10% penalty-free withdrawals if he wanted to. But outside of that, if he just lets it grow and accumulate, again, like this is a more so of a 10 to 15 years out of retirement.
Hmm.
Now, if it's, let's say if you're within 5 to 10 years out of retirement, that's a completely different product. Still a bonus, 25% bonus, but he can turn on income at year 3, year 5, year 7, year 2, and even in year 1. So it's just when you just turn on, you flip the switch and you turn on income. It's just a matter of that, right? You fill out a form, and so you'd like to turn on lifetime income. So that's just the main thing. And this is another point with annuities you see here. So even when you run out of money, you don't run out of income because there are guarantees associated with these illustrations that, again, it's for your lifetime, however long you live, right? So this all obviously goes only up to 30 years, but if you live another 10 years, this income continues to go.
So it's
So
similar to a pension.
yeah, so yeah, exactly just like a pension.
Okay. And then, like a pension, can you leave it to like your spouse once
Yeah,
you pass?
so you can do a survivorship withdrawal, or you can do survivorship, or you can do yeah, you can do I guess you can do like spousal income. So now this would be slightly less if you did that. So that way it can continue with your spouse. So let's say this is, instead of 29 as an individual, you do joint lifetime income. This 29 will probably be closer to like 20K as an individual, just so that way it sustains through both lives, both
Mm,
yeah, both living people. So so you can do joint income.
very cool.
Cool. Any other questions?
Yeah, just blur them out.
Okay, if not, I'm gonna move forward. All right.
Oh wait,
So
sorry, Justin. So what if like let's say somebody puts money into the annuity and they just let it sit, they don't take any money out. But life happens and they pass away, can they leave it to a beneficiary other than their spouse?
yeah,
Yeah.
absolutely.
Okay.
Yeah, absolutely. So now I'm actually facing this. This just recently happened. So I actually had two clients. One was the beneficiary, and one had an annuity, and he passed away recently. So there was a claim. And so speaking of that, that claim that the beneficiary was the sister, right? So it was the sister, and she could take the income as installments, over 5 years, or she could take it as a one-time lump sum, whatever he accumulated inside of the annuity, or he can do over 10 installment payments. Again, it's going to depend on what the beneficiary wants, right? So it's all going to depend on that. But exactly, yeah, you can leave it to if it's a non-spouse, you can leave it to a non-spouse. And then Michael, you have a question?
Yeah, is there a like a minimum to start an annuity?
Minimum, with this specific company, I know it's from company to company, it's different. So some minimums are 10,000, some minimums are 20,000, just as a one-time lump sum, right?
Okay.
Um, so yeah, it just depends on the company and depends on the product too.
Okay. And then the second part, I don't know if you explained this, but in that first year, it goes from 202 to 309. Um,
Yes. So
is
that's
that
the bonus.
oh the bonus? Okay. How do they do the bonus?
So there's a bonus on your protected income value. I do want to specify that. So your protected income value is the bucket that you're pulling income from. It's the most important bucket, right?
Mm,
So 202, you get a 45% bonus. So 45%, you can do the math, right? Plus interest for that year. So that person got a 5.54 credit for that year, right? And so now they got 309,000. So this is the most important bucket, the bucket that you're pulling income from. And then Rolando has a question. Could she roll it over to her own? What do you mean by that? Like roll it over to, um,
So you said the sister could take it either in a lump sum or get it over like a 5 year
oh yeah.
period. Could she take that and just roll it over into her own annuity?
So yeah, so that's actually what we did. Yeah, so that's speaking of that, so she can take it as a one-time lump sum, as a 5 installments, 10 installments, or she can roll it over. And so that's exactly what we did, is roll it over to her current annuity. So both of them had one, but the brother ended up passing away, unfortunately. And so that lump sum was transferred. We fill out the claim forms, that lump sum was transferred to her current annuity now. So we actually just completed that recently. So yeah, it could be rolled into hers.
And if she didn't have one, could she roll it over?
Yeah, she could.
Like she could just create create one, so to speak.
Yeah, so it'll depend on the qualification, the tax qualification. So if it's like an IRA, in the chassis of an IRA, yeah, she can roll it over. Just know that it's tax deferred. Now, if she wanted to roll it into an annuity, let's say if it's non-qualified, so that's like straight from the bank, right? So it's considered non-qualified funds where your principal is non-taxed, but the interest is taxed. Or if it's in a Roth, you can roll it into an annuity. Either way, you can roll it into the annuity.
Sorry, can I just to make sure I understand
Does
that?
that make
So
sense?
yeah. So you're saying from the lump sum she's getting, depending on how much of it was qualified money, like pre-tax money and post-tax money, will depend how much the beneficiary has to pay taxes on when she receives the lump sum, right? And then what she puts into the either existing or new annuity. That's
Yeah.
what you mean, right?
And so this is the alternative. Like let's say she received the qualified, it's a tax deferred IRA, right?
Mm-hmm.
Or tax deferred annuity. So she has to pay taxes on that. And she doesn't want to pay taxes, she can just roll that over into an annuity, right? Do a 1035 exchange and she wouldn't
Mm-hmm.
have to pay taxes on that.
Gotcha.
So but then again, on the income axis of it, she will have to pay taxes.
Right.
But if she wanted just to get the taxes out the way, and then let's say it's like 20%. So if it's 100,000, let's say 20%, you net 80K. 80K goes into the annuity. You can withdraw from it tax free.
Nice.
So, and then you know what it is too is like if you have the bonus, that makes up for the taxes that you paid,
Mm-hmm.
right? So, but again, it comes down to the different products. So it could be a 25% bonus or a 45% bonus, right? So, Alonso, does that answer your question?
Yeah, I think so. And it kind of works with the 401k. So let's say I had 50 grand in my 401k and I wanted to roll that over into an annuity.
Mm-hmm.
I would have to pay the taxes up front, correct? Because right now it's tax deferred.
No, actually, so with an annuity, usually we do 401k rollovers all the time. So you can do a 1035 exchange. So you can let's say that 50K, if you don't want to pay taxes on it, you can do it into the annuity and get the bonus as well. But just know that when you start withdrawing income in your retirement years, that income, depending on how much you take out, is taxable income.
Got it.
And then now, but if you wanted to just say, hey, you know what? I don't want to deal with the taxes. Just, tax me, convert it to a Roth, do a Roth conversion. So we have Roth conversions inside of an annuity. So it would be a Roth annuity. And then now that turns into tax-free income.
Mm.
So then let's say it's 50K, goes down to 35K, but then you get the bonus. So 35K times 0.45, obviously it's close to 50%. So let's say it's 17,000. So it bumps you back up to that 52K. And then now it's a Roth. So now that's tax-free income. So there's strategy there, right? So it just depends on if you want to pay taxes now or if you want to pay taxes later.
And what is the bonus again that you're talking about?
So the bonus is inside of the protected income value.
Got
So
it.
is this one has a 45% bonus. The other product that's more flexible, where you can take income at any point, is a 25% bonus. And then there's just regular annuities with just regular deposits as far as like, and then sometimes some other companies have maybe a 9% bonus or 10% bonus, right? So it just depends, but this product here is a 45% bonus. So you see deposit of 202, and then after that first year with the interest credit, it's 309.
And so it varies by carrier.
Yeah, it varies by carrier and varies by product.
Right.
So it could be, if you wanted the 25% bonus with more flexibility on income options, then I say go with the 25%. and then, but just know that, let's say, like you said, just your example, Orlando, is if it's 50K, let's say you paid the taxes at 15K, or I'll just say 20K just a buffer, right? 20K, you have 30, right? So now you have 30. Let's say you go to this 45%, you want to just let it sit and grow. So now you have 45%, that's roughly close to 15 grand. So then you got almost all of your cash back just by rolling it over. And
in
then
1 year.
now it's all tax free.
When you say tax free, are you still eventually having to pay taxes on the capital gains in that though?
If it's a Roth, no.
Okay.
Yeah, if it's a Roth, so there's Roth conversions, right? It just depends on the qualification. So is if this premium right here is qualified, meaning that it's a standard 401k, standard IRA, traditional, right, or it's tax deferred, you will be paying taxes on that money. But if the qualification is Roth, then guess what? Tax-free income here.
Because one is pre-tax dollars, the other is post-tax dollars.
Yes,
Correct.
exactly.
Okay.
Cool.
Great
Uh,
questions.
yeah. So Rolando, does that answer your question?
I think so, yeah.
Okay, cool. Yeah, feel free to ask some more. So now this strategy here is going to be integrating a whole life. Okay. So we have a client that is basically self-financing for their child's nursing school. We just recently actually we had an appointment earlier this week. Um, we took a loan for a policy to pay for the next quarter. So it's a very good strategy. I mean, it's self-financing, you're not having to take any student loans. And basically, they're using their whole life policy. So borrow tax-free, they're accessing funds without, unlike taxable events or unlike the 529 withdrawals and non-qualified expenses. So there's flexible repayment schedule. So there's not a mandatory repayment when you borrow against yourself. But I mean, obviously, if you want to be an honest banker, if we would pay the banks all this interest, we want to make sure we're paying ourselves, right? And then you have continued growth, so the cash value continues to earn. So even if you have 50,000, you borrow 30, it's still going to earn off that principal of 50,000, right? I compare this to like a HELOC, right? Home equity line of credit, where your home has a value. You're going to borrow against the home. You take a line of credit against the home. The value of the home doesn't go down, right? It still continues to grow in value. It's just the collateral, right? So that's the in a sense how the whole life works, but it's a little bit more flexible and non-reported to credit bureaus. All right, so let me go ahead and show you guys the actual example. So like I said, case study, nursing schools needed funding for school, minimizing the use of banks/school loans, and have more control of capital. So the primary tool that we used is the whole life. So you heard of the IUL, you heard of the whole life. We just went over in depth into the indexed annuities, right? So this is diving deeper into the whole life policy. So this is the tuition. And so actually due to specific, just I guess some of these specific fees that got waived, they didn't have to pay this full amount, right? So you see here, I want to show you guys the breakdown. So as you can see, 1016, she's making regular monthly payments, and then she takes a loan right over here. All right, so takes loans, and then she makes her regular monthly payments. Then she makes a loan repayment, takes another loan. So look, this is the first quarter, 12/31, 2025. Oh, I'm sorry. This is from the top down. I'm going out of order, right? So then the first loan was 9/10. The second loan was 12/31, and we just took one earlier this week. So it's all at 7,500 or basically 7,000. And so each time as she continues to make her monthly premium, she makes her loan payments. She's a responsible banker. So based off of her budget and what she can do, she repays herself, but she also deposits more money into the policy as well over time. And so I want to show you guys her actual statement. So client was able to finance her children's school. Her cash value still grow as if never touched. So she had her the year prior was 34,000. It grew by 3,000. So that's about an 8.8%. While becoming the banker and being or while being the bank and becoming being an honest banker, right? Is so she repaying herself, but she still continues to earn interest as if she's never touched it. So even though with all of those outstanding loans that she took from her policy, she still earned that interest credit of 8.8%.
And
So as you can see here, there's still loan information.
so for starting something like this, right? How much did she lump sum into the policy to start it?
Yeah, so she did front load the policy roughly, if I were to give it an estimate, roughly around 39,000 roughly. And then that was her borrowing power, right? As far obviously there's going to be insurance costs as well, but this was her borrowing power. I think it might even be less. Um, you can correct me if I'm wrong, Steve, right? I think this is the individual, right? So about 30, I would say it was even 30,000, right? As far as the front
I
load.
think the first one was around 30,000 to start the policy.
Yeah. Yeah, so 30,000. So she front loaded 30,000 and then made her regular contributions. So and by that she grew by this much. And this is I would say the second year in, right? So she had an 8.8% return. So even though she has these loans outstanding with the loan information here, she still continued to earn the interest. So obviously she front loaded it. We try to provide as much liquidity as possible, and then she makes her regular contributions, whether if it's that 400 amount or it's flexible to the individual, right? So she did front load it. That does provide a lot of liquidity and borrowing power up front, which gives it like kind of boost and like basically speeds up the borrowing power, right? Obviously, if you do like maybe 1,000 to 2,000 a month, like with one of my policies, I'm doing about 2,200 a month, right? So whether if you're doing a lump sum, and then another policy I did a large lump sum into it, right, where I have a lot more borrowing power versus doing 2,200 a month, where it's like kind of accumulating over time, right? So it's just going to depend on the individual.
But it's beneficial if you need the liquidity sooner, if you have a lump sum sitting somewhere to throw it in there, because it'll cover the cost of that first year, right? But then you have the remainder is all basically liquidity for you to use.
Yeah, borrowing power. Yeah, exactly. And one thing to note too on that is even when you borrow against it, I mean, it's still going to earn off that principal. And now, when you park that money in there, you don't lose out on the interest earning potential.
Mm-hmm.
And so what I mean by that is I had a client that had roughly 60 to 70K sitting in the bank savings account, and he got $10 after a full year, right? Send $10. So it's like now what he did was we reallocated it. Now he's projected to make a lot more than that as far as dividend side of things, right? So it's like anywhere between 25 to $3,000 a year in dividends. So what you're doing when you park your money inside of the policy is you keep the interest earning potential even when you borrow against it. So again, very similar to a HELOC when you borrow against a growing asset, right? Or even if you took a brokerage line of credit, right? If you have stocks or equities, you can borrow against the value of that as well. But again, the risk with, I don't want to go off on a tangent, right? But the risk with the brokerage account is that the index or the stocks or ETFs can go down and you can be called on margin. So now you owe the brokerage account, right? And then now the HELOC, obviously, that's a bank product. So you're on the hook to pay interest only payments or whatever payments that you owe. So, so that's the difference. So not to get off topic. So now,
I'm sorry, Justin. So I have a
yeah,
question as far as like a personal situation. like my mom, she has no retirement funds, but she has like 45K sitting in a 3-month CD that she's probably earning a little over 3% from. And the reason why she's doing that is because if something comes up and she needs money, how would this benefit her more than, being in that 3-month CD?
Than being in that CD. So like it just depends on what she needs as far as borrowing power, right? And the beauty about it is that if God forbid anything happens to her, right? If she were to park that money inside of a policy, there's also a death benefit associated with it, right? So that exponentially grows at the passing. Now, if she passed away with the 45K in there, it's just going to be that plus the interest, right? And then on top of that, I mean, there's also taxes that you have to consider, right? The interest that you earn in the CD is taxable. All of this under the section code, 7702, it's all completely tax free. So that's the tax benefits. I mean, you might have a little bit of taxes that you have to pay with the CD. And then there's also maturity dates, so it's not as flexible. You can't really borrow against the CD. You have to wait until it matures and then you can pull it out, right? So there's less flexibility. There's immediate flexibility here. I had a person who deposited money Wednesday, set up her portal Thursday, requested the loan Thursday, got her money Monday, right? And so the loan processes are pretty quick, but again, it's really just having that the initial principal earning interest, right? Even when she's using the money, she can still like she can pay herself back as flexible as she want, right? So that 45K would be earning here, even though she needs, let's say, 20K for this, right? And so the next year, let's say she gets interest credit of, let's say, just 5%. So 10% of 45K is 4,500, so 2,250 at 5%. So she made 2,250 at that, and then while still using the 20K here. So it's just the tax benefits as well as the flexibility, as well as the and also, like I said, the CDs at the maturity date, there's not as much,
Yeah.
yeah. So that's really just the different things if you were to really compare the two.
If I
Okay.
can, if I can piggyback one more comment on that, something for you to consider, or that anybody has to consider with anything like dealing with life insurance, is the cost of insurance for insuring you at your current age, current health, because you go through an underwriting process. So, you know, depending on her age and her health, it could be more costly for her to take a policy out on herself. But we have a workaround that where, say, she gets a policy on you because you're in good health and you take care of yourself and you're younger, the cost to insure you would be lower than for her, right? So then she would still be the owner of the policy. So she would still have access to her money. You would be the insured, and then there would need to be another beneficiary named. But that's just one more thing to consider, when you're doing all this, because it sounds good, the return and the guarantees and the protection and everything, but that's also something to take into account. But there are ways to get creative with it.
Yeah, I would definitely have to sit down with Justin and see, with my mom's situation, because she's definitely not in the best of health. But my other question is, when we were talking about borrowing from funds, so what would you do if, okay, so let's say someone has a 401k, they did do a loan on that, but now they're going to be switching jobs and they want to roll over their 401k into something like this. Um, what is the benefit? Like, how does a 401k, when you borrow from that, it seems like it's not the same as this, where if you're borrowing from it, um, you're only getting on what's left in there after the borrowing, whereas this, you're still getting interest based on the initial money that you put in there.
Mm-hmm.
Yeah, so loan provisions with 401ks are are much different. It's 50% or 50,000, like whichever's less, right? And usually when you do take that loan, I mean, I think they do a soft pull on credit, I believe. It depends on the company that you're with, but um, and they do have a forced repayment schedule, and it does tap into the principal. So yes, and it is volatile as well too. So it doesn't have the same loan provisions. Don't get me wrong. It's borrowing against the 401k is great. It's just like there's a forced repayment, right? And then there's also it does lower your principal that you're earning off of, and then there's a cap on what you can borrow, right?
Right. Right.
So there's nothing wrong with that. There's absolutely nothing wrong with that. But just know that if you do
Mm-hmm.
transfer it over, like let's say like you with that outstanding loan, right? Let's say whatever you took as a loan, and you transfer it over. Let's say maybe you transfer it over to your new employer, right?
Okay.
And then I think you might be able to carry that loan balance if they have the same,
Mm. Mm-hmm.
right? But if you transfer it over to let's to say like something like whatever's left in there into let's
Mm-hmm.
say an annuity, or let's say you want to reposition it into a policy, then that's where taxes will be implicated, right? And we have Jerry on here as well too that can verify some of that as far as borrowing against your 401k and basically transferring it over.
Mm-hmm.
Because whatever you took and you don't repay it back, because
Mm-hmm.
I had a client that defaulted on their 401k loan, and so they couldn't take any more loans from their 401k. So and it wasn't substantial. It was only like 6,000 that she had as a outstanding
Gotcha.
loan balance. But she had way more than on the balance. She had like I would say 70, 80k in there. Even though
Mm.
she had a 6k loan, she defaulted and she wasn't able to take another loan.
Mm.
But again, it's different companies have different stipulations, right?
Right. Yeah, this is the first time I've taken a loan and not they automatically take it out of your paycheck because you're still
Yeah.
with the company, but I'm going to be starting a new job soon. So now I'm like, okay, well, how's that going to work?
Yeah. So you can carry the loan if it's the same brokerage, right? Like if it's Fidelity or if it's Vanguard or anything like that, if you can carry it over. If not, I think you may whatever you took out, that's probably going to be added to taxable income. If you take the net of whatever you have left and rolled it over to something else, right? So I would again double check with your employer and double check with that floating 401k and see what you can do um, as far as the loan repayment and everything and their loan provisions, right? Because like I said, some companies, even though you have a $6,000 balance, they won't allow you to take any more. And then there's like a waiting period for some companies. I had a situation where with a client where there's a waiting period. Like they were about to take a loan from their 401k, but there was like a 30-day waiting period before they can take another loan. So what they did was borrow from this, and then they consolidated their debts and completed a lot of what they wanted to accomplish. So again, there's a lot there, but I mean, I think that would probably be, a separate conversation for us as well too.
Let me just add one more thing for Tuana. You said
Yes.
that you're going to start another job. So
Uh-huh.
if it's not the same brokerage that, let's just say your new employer is Fidelity, then yes, you could do a transfer.
Yeah.
Uh-huh.
If you can't do a transfer, let's just say they're with Charles Schwab or another financial institution and you have a loan, they're going to automatically close your account and it's going to be counted as a distribution.
Yeah.
Counted as income. So whatever that total loan amount is, it can also increase your taxable income.
Yep.
Okay.
Yep. Exactly that. Right. Yeah, that's exactly what I had mentioned earlier. Like as long as it's a similar brokerage, you probably can carry the balance. But if it's like a completely different institution, that's going to be added to your taxable income.
So they're just gonna maybe just take that money out from what is in my 401k and only roll over what's left and then tax me on whatever's left in the loan and then the loan is done?
Yeah. Yeah. So you won't have a loan balance anymore.
Got it.
Jerry, you want to
So
comment on that?
yeah, so they're gonna turn the loan into a distribution.
Yeah.
So it's no longer a low, so you're
Got
no longer
it.
in the monthly payments. You're now going to count it as income towards your tax return at the end of the year.
Okay,
So
got it.
basically, instead of the loan, they're just going to say like you just took the money out of your 401k
Yes, exactly.
or you cashed out.
Cool.
I have a question regarding this though. So you were talking about the loans. How many loans can you take out on it?
Multiple. Right now, I'm working with a client that's basically sweeping their rental property income through the policy. And so you can take a loan every single month
Yeah,
if you
that's how I
want.
was just literally gonna ask that. Like I can fund this. So let's say my mortgage is $2,000 a month, and I
Mhm.
could fund it. I could front load it with $24,000 for the year. And
Yes.
each year I could take the money out, or each month I could borrow the money to pay off or to put towards my mortgage and benefit from not only the gains on my property, but also the gains in the policy.
Yes. Yes. Exactly.
Oh, I need to do that.
So Justin, you might want to also talk about interest versus the interest rate, compound versus the simple interest.
Yes. Yes. So that's the thing is like when you're borrowing against hold on, I have to do this. I have to do this annotation. So like usually I have a touch screen and then now it's going to be like me just using my mouse, but don't mind me. But so compounding, right? So you're on a compound schedule. So it's going to continue to grow over time, right? So don't mind my drawings. Now, even as you borrow against it, you can repay over time, but it's going to continue to compound and grow. So now again, and the loan, let's say, you're because there's going to be a loan rate, right? Depends on the type of policy and it depends on the type of loan that you take because there's different loan provisions with different policies. So now let's say you're borrowing at 5 and then you're earning, let's say 7, right? So it's still going to earn off that 10K. Let's say this is going up at 7%. So that's still going to get $700, even though you're, let's say paying, and it's simple interest, right? So
Hmm.
$500 for the year. So even if you paid that within 2 months, I mean, you knocked it out, right? And so now you get to pocket more of that compounding interest. So uh, what I mean by this is basically you want to make sure that when you're earning it's different with amortized interest, compound interest, and simple interest. So the schedule on your policy is simple interest. So you can just literally, let's say you took a $100,000 loan and it's only 5%. That 5%, 5,000 is 5,000 for the year, right? So if you wanted to just pay the interest, you can just pay 5,000 right up front. So and then now it's just an outstanding loan that loan is again, I want to be very, 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 very careful when I say this. When you take loans from the policy, you want to be an honest banker and you want to repay yourself. But if you don't repay yourself, it's not the end of the world because it's going to be pulled from your death benefit. So hypothetically, let's say you had 100K in cash value, you have a 500K death benefit. Let's say you borrowed 75, okay, and you never paid it back. You never paid it back. So your borrowing power is only at 25 here. But God forbid something happens to you, this turns into 425. So it's collateralized by the death benefit, right? So they're basically giving you an advance, and this is going to continue to compound and grow.
So in my scenario, basically we would just be paying back the loan every month.
Oh, well, I think what you're doing is you're capturing the earning potential of the dollars, right? Instead of paying the bank, you're paying the bank the mortgage, right? You're front loading it. Let's say instead of basically what you're doing is sweeping it through the policy. That's what we do with a business right now is payroll, right? We're sweeping the payroll through the policy. They're borrowing against it to pay the payroll every month. They have roughly right around 100K per week in payroll expenses, right? So that's what they're doing is sweeping that monthly through through the policy, and they're borrowing against it, and they're still having that earning potential inside of the policy.
Yeah, that's what I'm trying to do too, is that I have a rental property and I put the money that I get from the renter into an account, and it's, one of those online accounts like Ally and Chime, where at least
Yeah.
in the savings account, it's more than 3% that you're getting.
Right.
So that the percentage that I get for the money that's in there, it kind of offsets it, because my mortgage rate is like 3.25%. But if I could put it into an account where I'm earning a lot more than that, and then do these mini loans every month and then pay it back, I would be earning a lot more
Yep.
on that bulk of the money.
Yeah, so you're just recapturing that earning potential of the dollars, right? Versus like this is the illustration I always go through. So if it goes from bank, let's say your bank account, to mortgage, earning potential of those dollars gone, right? So let's say it's 2,000 per month, like your example, Rolando. So 2K is going straight to the mortgage loan or to the mortgage. Versus if we, sorry, I wish I had my touch screen. Probably need an iPad, Jerry. But
Just to really simplify it, if you just think of like a car loan, it takes so much longer to pay off than a credit card, right? So a credit card is simple interest, a car loan is a compounding interest. So if you're paying off the same amount for each month, it's just easier and much faster to pay off a credit card. So this peer-to-peer lending would be offsetting the credit card analogy versus paying off your mortgage as a compound interest.
yeah. Exactly. So this is really the flow chart too. So like instead of the bank going straight to that mortgage, it's you're parking it here, leveraging it, and now all your earning potential of your dollars, instead of it giving away, right, to interest, front-loaded costs and fees into the mortgage, right? It's now parked in here, and now you're leveraging it and then paying it off here. So I would like to describe this as a sweep account. A lot of people tend to use this as a sweep account, right? To kind of use this to basically park it in. Again, there's different uses for this. So if you wanted to, let's say you wanted to buy a car, right? You got a quote from a company, it's 35,000, 11% interest, it's about $800 a month, right? And then now over, let's say, a 7-month term or something like that. And all that money, all that $800 a month is going towards the car company or the loan company that gave you the loan for that. So now if you just park that money, take that same quote, borrow against your policy, pay for the car in cash, and now repay yourself that same thing, and now you're recapturing all that interest. And it's volume, right? It's all the volume of interest that you're putting into the policy. It's volume versus interest, right? So
Got your wheels turning, huh?
yeah. Yeah, and then so I'm going to show you guys an actual example of someone doing peer-to-peer lending with a promissory note. So there's going to be an individual, on a preface it, where they needed to a consolidate their debts at around 33,000, and they wanted flexibility. They couldn't get approved through some of the banks. They couldn't get loans, and the loans sometimes were too high in interest, like up to the 20s. So what they did is I had one client basically leverage their policy and then lend to that individual on a promissory note, and then that individual is paying them back. Obviously, we put aside collateral. We make sure both ends have a win-win situation, right? T's are crossed, I's are dotted. If need be, there's a UCC1 filing. Like, shout out to Jerry on that, right? So I'm going to show you guys the actual numbers here. Okay. I know this is a lot, but over here, this is the promissory note. So the principal sum, this is for debt consolidation. Principal sum is 33,000. It was at 11% interest. It was over 5 years. Usually, the longer the term, the higher the interest rate. We try to negotiate for our clients and for also the borrower as well. So that monthly pay is right around 717.50 per month. So you see here, 717.50 per month. This client, they already had built up cash of 38. This is their borrowing power here, 38,000. This is their accumulation value. So remember, when you park the money in there, that's going to be the interest earning potential, right? So this is what they're earning off of, their accumulation value. This is their borrowing power here, right? So now they borrow 33, they lent to this individual, and now this individual is getting paid every month, getting cash flow, 717.50 per month. And so now I'm going to show you even in a additional step, right? That this person is now going to be having their dollar do three different things. So remember, they borrowed against their policy, but it's still earning off this 41 here. So it's earning here, right? They're getting cash flow from this. And now what they're doing with this collected cash flow, they're now putting that inside of a high yield savings account. So that 717.50 that they're earning every single month, they're allocating that. So that collected capital is earning interest. In the policy, they're earning interest, and now they're earning cash flow from those monthly payments. And over time, they're earning, going back to this other slide, they're earning total in interest. Let me see here, sorry, $10,000. So they have their money doing three different things here, or earning three different ways through the promissory note, inside of the policy, and now they're taking this collected 717, putting that inside of a high yield savings account. So their dollar has three different ways of earning interest here. And so obviously these are some of the returns that they had this past year, their recent statement. So client earning cash flow on the note, earning cash inside the IUL account, just what I just said. And then we'll be putting collected capital inside of the high yield savings account. So it's earning three different ways. Okay, so this is basically a strategy that we basically came up with this client. And you know, they're all for it. You know, just have to be open to it, right? Because they were so used to just saving money and putting it in the bank. They didn't know about all of these different strategies and leverage and promissory notes and all of these different things, right? So that's another way to be a private lender, and you can collect capital, have cash flow, 717 coming in per month, $10,000 in total interest there over the life of the note. And then on top of that, you're earning interest in the policy and in the high yield savings account. So pretty cool. So now this is going to be a debt consolidation strategy, just the individual itself using his own policy. So just like what you guys were saying with the mortgage example, this is going to be kind of the same thing, but with, let's say, a high amount of debt in credit cards, right? So he has, you know, high interest debt, 18 to 24%. He can borrow at 5 to 8, right? So it's a much more comparable interest rate. And so there's no credit score when you take a loan from your policy. There's none of that. This is your money, right? So there's not an approval. There's a simple clicks of buttons. So what he did was he continued to put deposits into his policy, right? So he made the premium payments here. He put an additional 10,000 here. And then now like he funded this heavily, right? So he funded it maybe 15,000 and then initially 750 a month, and he actually let it accrue over the first year. Hold on. Oh, okay, yeah. So yeah, I saw that. All right. So anyways, I got a message. But so anyways, the premium payment was here, and then the paid up additions rider was here, right? So then you see the lump sum. And then he did this for about a year and a half. And so he was able to take a max loan of about 28,000. So he used this amount to consolidate a lot of his credit card debt. Then he kept continuing to make his regular payments, right? And then now he makes his loan repayment, 1,700. So he's being an honest banker, but he's flexible. See how he doesn't have a fixed like $700 payment for his loan. He's like, hey, I'm just gonna pay this back with whatever freed up cash that I have, right? And then now this next year, you see loan payment. He made another $8,500 loan payment, and then another deposit, and then another loan payment, and then guess what? Another $11,000 loan. So loan initiation. So that's now $39,000. He allocates that towards the debts, and he makes his regular payments. So this is just him using his policy by himself, right? So he sporadically is repaying himself back. And then now here, he also get his dividends, right? And then he makes his regular premium payments, makes his loan and his next loan 6,700, and then he continues to make his loan payments. So he's making his deposits into his bank, saving inside of his bank, taking his loans as he goes, and then making sporadic loan repayments. So does he have to, is he on a fixed repayment schedule? No. He can take, let's say he has freed up cash flow for 1 month. He had a good month of work. Then he can put a lump sum there. So provides flexibility, but he consolidated, how much was that? About $46,000 over the life of that. So then and then after this, here, let me go back. We have a lot of examples, but we're going to wrap up in a second here because we had a lot of questions. So he consolidated all of that. So now there's investing in private real estate deals. And so I know, Toronto, you probably work with some development. You know, some of these people work in the real estate space as well. So there's an opportunity here where we have investors through their policy are leveraging to go into this private real estate deal. So now not every deal makes sense. If you're borrowing from your policy to make only 2%, that makes absolutely no sense.
Yeah, I work for a small community bank, and that's basically what I work doing. I'm the underwriter, and I work with real estate development companies. And of course, they're always looking for investors so that they don't have to take out interest only loans at banks.
Yeah. Yeah. So yeah, we always get so there's a lot. I mean, that's been kind of on my desk. I think Michael Sowell, Steve knows, Jerry knows that there's a lot there. Like there's a lot of opportunity out there. And so private investors is probably the easiest way versus going through like a hard money lender, right? Or going through any sort of other lender. So what this does is when you're leveraging your policy, you're going into this deal. And so we had a recent promissory note, and it's 18% compounded per annum. So pretty solid. She leveraged her policy at 50,000, is earning 18% per annum. So it's going to be expected loan repayment or balloon payment at the end of the term, at the end of the 6 months. And then now if she wants to hold it a little bit longer, like it's 18%, right? So of course she wants to leave that there. So now this is just to show you guys that she took the loan. So now last year her dividend was roughly around $7,000. So we're projecting the same thing, around $7,000. Let's say it could be more. Honestly, it could be a lot more for the dividend because usually the dividends increase year by year. So her dividend could be, let's say it's 7K again. So it's 7K here. She earned 9K in the real estate investment, and then now that's 32% cash on cash return just by adding that additional step. All right. So this is the payments that she deposited into her policy. Took a $50,000 loan, invested, boom. So she has the multitasking dollars. And then, yeah, so this is really just, again, another one where it's another type of private loan with a business for operations. This one was a specific for material, the Open Gate LTE board, where it was for a security material where it detects metals that can be used for weaponry, right? So the amount was 45,000, 7%. And then now that person who loaned from their policy is collecting a 1393 payment per month over 3 years, over 36 months. And it's beautiful because she's been receiving much more extra payments. She receives 1,500, 2,500, 3,000, 1,300, her regular 1393, right? So she's collecting this passive cash flow while replenishing her loan, and she can reuse that capital to deploy and go into another investment and develop more cash flow, right? So that's what she's doing. And then obviously you see here, right, loan repayment, this is what she's been doing. She took the new loan. She has the loan repayments. See, she collected 2,500 this month, two 1393 payments, and then two $1,500 payments. This is just a recent statement here, right? And then obviously This is the whole life example that I have where this person's actually sweeping their rental income. So they collect 4750 per month. They front loaded it with about 5,000, right? Or 20, that's I guess you can say 5250, right? So it's 4750 and then 5250, which makes it 10,000. So 5250 front load and then 4750 per month, and then they're sweeping through their income here. And so even by year 5, imagine putting 57,000 in, receiving a dividend of $10,000. And then by year 5, they already have 297,000, and by year 14, they have 1 million. So they're sweeping it through. They're taking the loans to pay their expenses, right? Sweeping it through, pay their loans, to consolidate debt. So even after that first year, they're going to be able to consolidate about 30K in debt. Actually, just was recently texting this individual anyway, right? So as the dividends continue, even by year 11, 57,000, 24,000 in a dividend. That's insane, right? So it's just as these compound and grow and continue to grow, even though you take outstanding loans, it's still going to continue to compound, right? And this is a non-correlated asset. This is not tied to the stock market. This is based off the profits of the company, right? Obviously, it continues to grow, but they also have guaranteed contracts as well, where there's guaranteed growth. And
Hey,
then this is another,
Justin, I was gonna say just because we're out of time here, and I just want to
yeah,
make sure everyone's on time to where they need to be. But why don't we first? I want to, if everyone can type in the chat if you found this helpful. Uh, just say what you found helpful, and then we're going to continue the second part of this because you know I think we can revisit from the real estate example on, but invite anyone you think might need to get in on this or just be exposed to this information. And then next Wednesday, we'll just pick it up on the real estate example and then cover all this again. So then, because I mean, it's a lot to condense into a short amount of time, you know.
yeah,
But
because we spent a lot of time on the annuity side.
yeah, but you know, great questions, and that's the whole point of this is to get conversations going. So I'm glad everybody spoke up and you know asked the questions because that's what we love. We love to answer questions. So next Wednesday, same time, the email that gets sent out to you, feel free to forward that, and maybe we'll send one out like Tuesday. You know, just so I think one goes out on Tuesday for the next day. But
Yeah.
yeah, send it to anyone. You know, all they need is the link and then to type it in, and then they can have access. We'd love to have them, and we'd love to answer some questions.
Yeah, we did a pretty good deep dive into this information. I mean, obviously, this was kind of the end of the presentation anyway. This was just an IUL example. So yeah, we're just going to get more into detail. I mean, there's a lot of strategy here, a lot of ways to have your dollars do more than one job. So um, hopefully, you guys took some value from it. But yeah, anything else before we go? I mean, do you have anything, Saul?
No, just join us next week and bring someone else that's going to also benefit. All right, y'all. Have a great night. We'll call it there. Thank you.
Cool. Take care.